Good morning, everyone. I'm excited to welcome you to today's presentation. We'll be exploring the fascinating world of cost and management accounting. On this first slide, you'll see the title of our session. We'll be delving into how these accounting methods help businesses make smarter decisions, control costs, and improve overall management. Over the next few slides, we'll cover key concepts, techniques, and real-world applications. So let's get started and discover how cost and management accounting can make a real difference in the business world. Now, let's move on to the first question. What is a cost sheet? A cost sheet is essentially a detailed document that outlines all the costs involved in producing goods or services within an organization. It helps us understand exactly where our money is going and gives us a clear picture of the total cost incurred. Understanding this is crucial because it allows managers and decision-makers to evaluate profitability and control expenses effectively. Next, the second question asks about the components of a cost sheet. It mainly consists of three parts: direct costs, indirect costs, and other costs. Direct costs are those that can be directly traced to the product, like raw materials and labor. These are the costs you can assign specifically to each unit produced. Indirect costs, on the other hand, are not directly attributable to a single product, but are necessary for the overall operation. Things like rent, utilities, and salaries of supervisory staff. And then there are other costs, which might include expenses like depreciation or miscellaneous costs that don't fit neatly into the other two categories, but are still part of the total cost picture. By understanding these components, we get a comprehensive view of all expenses involved, which ties back to our overall goal of effective cost management and pricing strategies. So, in essence, a cost sheet is a vital tool that consolidates all these elements, giving us the insights we need to make informed business decisions. Now, let's take a closer look at some key terms that help us understand production costs better. First up is direct material. This refers to the raw materials that are directly used in making a product. Think of it as the essential ingredients that go into creating what we sell. Without these materials, the product simply couldn't exist. Next, we have factory overhead. This covers all the costs associated with running the factory that aren't directly tied to a specific product. Things like electricity, maintenance, and factory staff wages fall into this category. These costs are necessary to keep the production process moving smoothly, even though they aren't directly part of the raw materials. Then there's depreciation. This concept is about how the value of our tangible assets, like machinery or equipment, gradually decreases over time. Instead of a sudden expense, depreciation spreads out the cost of an asset over its useful life, reflecting how it wears out or becomes less efficient. Finally, let's talk about fixed costs. These are costs that stay the same regardless of how much we produce. Examples include rent or salaries, expenses that don't fluctuate with production volume. Recognizing fixed costs helps us understand the baseline expenses we need to cover, no matter how busy or slow our operations are. By grasping these terms, we're better equipped to analyze and manage production costs effectively, which ties into the overall theme of understanding how to control expenses and improve profitability. Now, let's delve into some fundamental concepts about costs and wages. First, what exactly is a variable cost? Well, these are costs that fluctuate based on the level of production. For example, raw materials and labor costs can increase when you're producing more and decrease when production slows down. Essentially, variable costs move in tandem with your output. Next up is prime cost. Think of this as the total of all direct costs involved in production. It includes raw materials and direct labor, things you can directly trace to the product. Prime cost gives us a clear picture of the immediate expenses tied to manufacturing. Moving on to wages, simply put, wages are the compensation paid to workers for their services. It's the reward for their effort and skill, and a key component of direct costs when it comes to labor. Finally, let's talk about what determines wages. Wages aren't set arbitrarily. They are influenced by several factors. Labor laws set minimum standards to protect workers. Industry standards help keep wages competitive within specific sectors. The nature of the job also matters. More specialized roles tend to command higher wages. And of course, the capacity of the organization plays a role. Larger or more profitable companies might offer higher wages to attract skilled workers. All these elements are interconnected and crucial for managing costs effectively, which ties back to our broader focus on understanding how costs impact overall business operations and profitability. Now, let's delve into some key concepts related to employee incentives and pay systems. First, what exactly is an incentive? Well, it's a special payment made to employees to reward their achievements or performance. Think of it as a motivational boost that encourages better productivity. Moving on, overtime pay is another important concept. This is the additional compensation employees receive when they work beyond their standard working hours. It's designed to compensate for extra effort and time put in. Next, we have the time rate system. Under this system, employees are paid based on the amount of time they work, regardless of how much they produce. So, the focus is on hours worked, not necessarily the output or efficiency. Finally, let's talk about the Halsey plan. This is a type of time-based incentive plan where workers are guaranteed a regular wage for completing a standard amount of work. If they finish the task in less time than expected, they earn a bonus. It's a clever way to motivate workers to be both efficient and productive by rewarding them for saving time while ensuring they're fairly paid for their effort. Connecting all these concepts, they form part of a broader discussion on how to effectively motivate employees and structure compensation to promote productivity and fairness in the workplace. Now, let's explore some specific costing systems that help us understand how costs are allocated and managed within a business. First up is the piece rate system. This is quite straightforward. Employees are paid based on the number of units they produce or the tasks they complete. So, if someone works faster or more efficiently, their wages directly reflect that productivity. It's a simple way to motivate workers to increase output, especially in manufacturing settings. Next, we have job costing. This method is all about assigning and tracking costs for individual jobs, projects, or batches. Imagine a custom furniture maker or a construction company. Each job has its own unique costs, and job costing helps us keep track of each one separately. This ensures accurate cost control and helps with pricing and profitability analysis for each specific job. Moving on to batch costing, which is similar but applies when we produce a group or batch of products together. Here, we calculate the total costs for the entire batch rather than individual units. This method is useful when producing items in large quantities, like pharmaceuticals or baked goods, where the cost per batch is more relevant than per item. Finally, let's talk about EBQ, or economic batch quantity. This concept helps determine the optimal batch size that minimizes total production costs, considering factors like setup costs and holding costs. Sometimes called economic production quantity, or EPQ, it's a strategic tool to balance production efficiency with inventory management. Using EBQ ensures we produce just the right amount, neither too much nor too little, helping us operate more efficiently and reduce waste. Connecting all these concepts to our overall theme, they illustrate how different costing methods can improve decision-making, cost control, and productivity in various manufacturing and service environments. Understanding when and how to use each system is key to achieving operational excellence. Now, let's wrap up our discussion with the financial statements and cash flow statement. When we talk about financial statements, there are two fundamental ones to keep in mind: the balance sheet and the profit and loss account. The balance sheet gives us a snapshot of a company's assets, liabilities, and equity at a specific point in time, while the profit and loss account shows how much money the company earned and spent over a period, essentially revealing its profitability. Moving on to the cash flow statement, this is a crucial report because it tracks the actual movement of cash in and out of the business. Unlike the income statement, which includes non-cash items like depreciation, the cash flow statement focuses purely on cash, highlighting how cash is generated and used during a particular period. This helps us understand the company's liquidity and how well it manages its cash. Within the cash flow statement, you'll find three main components: operating activities, investing activities, and financing activities. Operating activities involve the core business operations. Think sales, payments to suppliers, and employee wages. Investing activities relate to buying or selling assets like equipment or investments, which can impact future growth. And financing activities involve raising or repaying capital, like issuing shares or taking out loans. Recognizing these components is vital because they give us a clearer picture of how the company sustains itself, funds its growth, and manages its financial health overall. By understanding these statements and their components, we gain a comprehensive view of a company's financial position, not just on paper, but in real cash terms, allowing us to make better informed decisions.